Good Sunday afternoon, everybody. Welcome back. My name is Seth Golden. This is another macro market research video by Finom Group. It is Sunday evening. The futures markets have already opened. Just kind of thought I'd stop by and give you some of the latest thoughts from the top of my dome if you find them interesting, insightful, and worthy of your click and share. I greatly appreciate that. And also, if you like this kind of content, subscribe to our YouTube channel. Visit us at phenomgroup.com to subscribe to our weekly exclusive research. With that being said, let's jump right into it, folks. As you can see here, I've got a tweet by Zero Hedge. Nasdaq breath is about the worst it has ever been. That doesn't seem consistent with price, right? Because the Nasdaq has the Nasdaq's leading, right? This year in 2023, the Nasdaq has the greatest gain year to date. So when you see this kind of a tweet from Zero Hedge, and it's a factual tweet, the advanced decline line is almost at a new all-time low. And what we tend to understand is, and I shouldn't say tend to understand, what is a factual representation of most indices is that breadth leads price. Good breadth or strong breadth tends to lead to better price action. Weak breadth or weakening breadth tends to lead to some kind of corrective behavior in the index's price. So not good, obviously. This is the advanced decline line down here in the red, and this is the Nasdaq itself in the black going higher. I'm colorblind for those of you just joined my YouTube channel or Finom Group. You'll get used to it. I try my best. Usually I have it rehearsed. I have my wife check out and examine and inform me of what the colors are. But again, kind of just reaching out, touching base here ahead of the trading week. So didn't go through that with my wife. Anyway, here's another tweet, pretty much kind of the same thing. This is not bull market behavior. Commentary from Willie Delwich, who is a certified market technician. I know Willie, good guy, does great work. I wouldn't say I'm always in agreement with the guy, though. The tweet he's responding to or retweeting is from Markets and Mayhem, kind of one of my stay away from. And don't get me wrong, they put out a lot of decent stuff and what have you. But there's a lot of fear-mongering in the Markets and Mayhem camp, so to speak. Despite the powerful rally in the Nasdaq yesterday, and this was going back to April 28th, there were still 166 more new lows than new highs. Not really what you'd expect from an index that is, again, just moving higher. Willie Delwich says not bull market behavior. My question is, if it's not bull market behavior, is it bear market behavior? The thing you have to note about and understand about the Nasdaq, it is very unique compared to its peer large cap indices like the S&P 500, the NYSE, or the Dow Jones. The Nasdaq is a highly concentrated index. It's a growth index. 12 stocks make up roughly 50% of the market cap weighting within the Nasdaq. So it has no material stocks in it, has no energy stocks in it, but it has a plethora of speculative, unprofitable stocks that also include biotechnology stocks. It's just a very different beast. And I don't necessarily think that you can take the disciplines of recognizing breadth and new highs versus new lows, the advanced decline line for the Nasdaq. I don't think you can take the disciplines from the other large cap peer indices and attach them to the Nasdaq because it is so highly concentrated. Whereas 12 stocks make up 50% of the Nasdaq, it's about 25 to 30 stocks that make up that amount in the S&P 500. So it's just very, very concentrated. A lot of speculative junk in the Nasdaq beneath the surface. Here's an interesting chart I want to kind of blow up here from Mark Ungewitter, very, in my opinion, objective market watcher and market participant, chartist. This chart identifies the S&P 500 going back to 1990. And what he's identifying here in the chart is that the Nasdaq advanced decline line typically bounces off of the S&P 500 cyclical bottom. Cyclical bottoms are marked with these perpendicular lines in red. Yeah, that's got to be red. So every cyclical bottom, corrective, if not an all-out bear market, is marked with these perpendicular red lines. And the Nasdaq, here's the Nasdaq AD line, and that is, here's the S&P 500 cyclical bottom. And then you get a bounce in the Nasdaq, but usually it just flatlines and rolls over. Here's another cyclical bottom in the S&P 500. You get a bounce in the AD line, a bounce in the AD, but then it rolls over until you get to the next cyclical bottom in the S&P 500. You get a quick bounce, but then it rolls over again. So pretty much every cyclical bounce in the S&P 500 leads to a cyclical bounce in the Nasdaq AD line, but that quickly rolls over. Again, here's a cyclical bottom and bounce in the S&P 500. Here's the bounce in the Nasdaq AD line, but then it rolls over into the next corrective phase of the S&P 500. So it just goes to show you that, when things get too cheap, everything rallies. But then investors become stock pickers. And the Nasdaq has a lot of junk. So you're not going to be buying most of the Nasdaq. You could be buying most of the S&P 500 because it doesn't have as much junk in it. But it also shows you why the Nasdaq advanced decline line is not a really good gauge of, a bull market. Is not a good, you can't distinguish whether it's a bull market or a bear market by looking at the Nasdaq advanced decline line, as these investors and publications would have you to believe. It doesn't distinguish between bull and bear markets. So here's a chart that I constructed over the weekend, and it's the advanced decline line for the Nasdaq. And folks, we're talking about the Nasdaq Composite Index. We're not talking about the Qs, the Nasdaq 100. We're talking about the Composite Index. We will get into the Nasdaq 100 in just a second. But this is the advanced decline line chart going all the way back to 1990. And you can see, I mean, it did make a new all-time low in 2022 and early 2023. Now, here's the problem with using the Nasdaq advanced decline line as a gauge of market strength, or the Nasdaq strength or weakness. Over that same time span where the advanced decline line did nothing but go down over time, the Nasdaq Composite Index in the bottom gained 2,569%. Get it? Enough said? It's just a very special index. So be careful with using the advanced decline line as a measure of breadth weakness or strength, and how you think that should play out in the composite index itself. Okay, here's another chart. This is the Nasdaq 100. I told you we get to the Nasdaq 100. Stocks above their 200-day moving average, which is a sign of long-term strength, long-term breadth strength in the Nasdaq 100. Right now, or as of Friday, 70% of Nasdaq 100 stocks are trading above their long-term moving average. Not only that, folks, but in terms of indexes, it is the only index that has not seen less than 50% of stocks in the index above its 200-day moving average year to date. It's the only index. The Nasdaq 100 essentially gets rid of the Nasdaq composites crap. It's fewer stocks, 100 stocks. It's the goods. It's the good stuff. It's the quality of the Nasdaq composite itself, just refined into a smaller index. Trend line, beautiful, going back to the October bottom. Kiss here in late October, kiss here recently in April, bounced right off the trend line. Talk about your buying opportunity, right? That's what we do sometimes. That's sometimes why we do technical analysis. All right. We've talked about, is it a bull market? Is it a bear market? There's still, I kid you not, there's still a lot of debate. There's probably an equal amount of investors up. No, I'd say there's more investors that are in market participants that are leaning to the bear market rally side of the ledger. Now, this chart right here is a relative performance ratio of the Qs, Nasdaq 100 ETF, if you will, versus the Dow Industrials ETF, DIA. It's a relative performance ratio, and what I'm identifying here is that the signs of a new bull market has typically, and this goes back to 2002, the sign of a new bull market has been defined by Dow Theory 2.0. Most of you are familiar with Dow Theory, what we call 1.0 today, which is the Dow versus the Dow Transports, or both of them confirming each other. If one of them is in bull market territory, the other one should be as well. If one is uptrending, the other one should be uptrending. That's Dow Theory 1.0. But you can also use the comparison, with the Qs as Dow Theory 2.0. So what I'm showing is that a sign of Dow Theory 2.0 confirming a new bull market. Typically, what you'll see is if the bottom panel here is the 12-day rate, the 12-week rate of change. When you get these big spikes, right, so that's essentially 3 months, I believe, 3 months, right? Or almost 3 months. You see the big spikes? They are typically the start of a new bull market where the Qs are outperforming the Dow Industrials. Happened here in late 2002, which just so happened to be the bear market ultimate bottom from the dot-com and 9/11 time period. You get this big rate of change spike, and market never made a lower low. And here we go again, 2009. Look at the spike in the rate of change down here. It gets above 15%, the rate of change. Dow Theory 2.0, up, 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 and away. Once again here, COVID, Dow Theory, we have the rate of change, big spike above 15%, up and away, folks. And once again, here we are. Big spike in 2023. Here's a thumbnail so you can get kind of the zoomed in picture where we have the rate of change down here, spike above 15%. Historically, you've been in a new bull market based on Dow Theory 2.0. Here we're going to reverse it. We're reversing Dow Theory 2.0. So the Dow over the Qs. In this one, we had the Qs over. So we're just showing you there, the trend line is pretty consistent. This has adhered to the trend line. So Dow is underperforming the Qs through this whole time period since basically, started here in early 2003, 2003 is where the underperformance began. If we connect our lower trend line here, it's perfect, folks. And what this basically signals to me, there's a lot of room for the Qs to outperform. This can, has a lot of room to the downside here. In speaking to breath. Yep, okay. Of late, this is the NYSE net new highs versus new lows. And what we can see is underneath the surface, folks, this is we start the year. We've had a lot of weeks. This is the weekly, a lot of weeks where the market was making more net new highs than new lows. We had 3 weeks here in March where you had net new lows. But this is in sharp contrast to last year, 2022's bear market, where you were making a lot of red candles, a lot of net new lows rather than net new highs. The behavioral characteristic of a bull market is to have weeks of net new highs outpacing weeks of net new lows. So this is bull market behavior. And more recently, it's been increasingly more bullish as the net new highs have been outpacing. Again, looking at the Nasdaq 100, same thing. A lot of weeks of net new highs. Now, if I pulled this up and looked at the Nasdaq composite net new highs, it's not going to look as good. Nasdaq, not Nasdaq 100, but the Nasdaq composite, a lot of red candles. There's a lot of junk. There's just a lot of junk. This is why the advanced decline line looks as bad as it does for the Nasdaq composite. A lot of junk, but the Nasdaq 100, very different picture. Quality in the Nasdaq 100. Again, kind of the same picture here, but I'm identifying the differences between those bull markets and bear markets. This goes back to 2020, folks. This chart of new highs minus new lows. In 2020 into 2021, I mean, rarely do we had 4 times where you had net new lows outpacing net new highs. This was the everything bull market, which followed a big bear market in 2022. This year, I think what we have is a stock pickers market. You still have actually a reasonable amount of weekly net new low candles. You have more net new high candles, but I think the fact that these are not quite equal, but maybe 65, 35, I would have to guess that there's a lot of stock picking going on. It doesn't make it any less of a bull market, but it means that the average investor is being more restrictive with their purchases. They're not speculating. Again, Nasdaq advanced decline line. Nasdaq, a lot of speculative stocks. Investors are exercising good discipline. I'll put it that way. Now, I just kind of wanted to re-up this chart as well for those of you who have seen this before, but if you're new to it, this is the S&P 500 chart going all the way back to 1995. And the S&P 500 notched. When I first published this, actually the study is by Hugh Karlowitz. This is the tag for his Twitter. And it says the S&P 500 notched 2 consecutive monthly closes greater than the 10-month moving average, circled here, occurrences circled here, here, here. And what you'll notice is once it performs this feat of bullish strength, the market has never made a lower low since 1995, has never made a lower low. And so this was published February 28th, which means January above the 10-month moving average, February above the 10-month moving average. By the way, March above the 10-month moving average, April above the 10-month moving average. Again, folks, no lower lows. Actually, since 1960, there's been 14 occurrences, although this chart only goes back to 95. Since 1960, this has happened 14 times, and the market has never made a lower low. Earlier this year, I'm going to go a little bit faster, NYSE, which is the summation index, the New York Stock Exchange summation index, exceeded 900 for the first time in at least a month. Historically, you get a lot of positive returns. The positivity rate 1 week out to 1 year. Things get really good going out, let's say 3, 6, 12 months, all in the 80 percentile or better. So let's see, on January 30th, the summation index crossed 900 for the first time since 2020. The S&P 500 at that time was 4017. Forward positive return rate 3 months later, 88% of the time it's positive, 88% of the time, and we indeed were. As we went out yesterday, the end of April, or I should say Friday, the end of April, 4169 from 4017. By the way, folks, pretty healthy gain from 4017 to 4169. Nicely done. History is at least rhyming. This is another study, just wanted to refresh, from Steve Depp. It's called the 2 and 10, and it recognizes a 2-month 10% or greater advance in the S&P 500, which signaled back on November of 2022. Prior to that, it last occurred also in May of 2020. So November, December, January, February, March, April. 5 months later, the positivity rate, let's see here, percent time higher, 5 months, almost 91%. Where were we November to end November of 22? 4,079. We are at 4169. We are higher. But here's the beauty, folks. 6 months later, so May, at the end of May, folks, after this signal, 100% of the time, 6 months later, the market has been positive. 8 months later, 12 months later, 100%, 100%. Keep in mind, folks, keep it in mind. All right, now let's get to my fun facts of the week. Because all we heard is, well, when the Fed pauses, they're probably going to have to start cutting rates eventually because the economy is weakening, blah, 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 blah. And when if they cut rates, then, that's not a good thing. The market's going down. Stop saying stupid That's, these are my fun facts of the week. It's just not the case. When the Fed pauses, historically, the market is higher. The only time since 1995 that the market was lower was the 2000. Again, most any of these historical data studies, these quant studies, most of them that failed, they failed during the .com/9/11 period, which also came with a mini recession of sorts. But all the other times, look at 1 year later after the Fed paused, 35% gain. 1 year later, in the 2006 cycle, 20% gain. 2018 cycle, 27+% gain. The average, 1 year later, 17.5%. We got a Fed meeting coming up this week. They're going to hike by 25 basis points. Most market participants are anticipating the actual signaling, phrasing, or framework articulation of a pause. And it's taken a lot for the Fed to get here. The last thing the Fed wants to do is to pause and then restart immediately, because that will signal chaos to markets, I think. So it's been a reluctant Fed to get to this point, but I also believe that they've wanted to get to above 5% on the effective funds rate. And that's where they'll get with this 25 basis point hike come Wednesday this week. My other stop saying stupid fact of the week is, people say, well, the market's too expensive. Look at the CAPE ratio of the S&P 500. There's no signal here, folks. The S&P 500 has had a bear market along all different valuations for the CAPE ratio. I mean, this goes all the way back to 1926. We had a bear market when it was high. We've had bear markets when it's low, and everything in between. Valuations are actually negatively correlated with forward S&P 500 12-month returns. For those that believe or think or opine whether or not valuation should be front and center when they consider allocating to, and I'm speaking mainly to index ETFs, that is the wrong framework, folks. That is the absolute wrong framework to be using when it comes to making decisions on capital allocation. Good earnings season, folks. So far, so good. I mean, and we knew this, right? I mean, I've been saying this since the fourth quarter of last year. I'm like, it's just not that bad out there. The gloom and doomers, most of it is just a rate of change issue. It's not, it's not pure weakness in the earnings or sales. It's not pure weakness of demand. It's rate of change. When you grow earnings by double digits and then you grow them by high to mid single digits, what do you think comes next? Continued deceleration of earnings, which we are getting here in the first quarter of 2023. But coming into the quarter, they believed, the analysts or the consensus analyst estimate believed that the S&P 500 earnings per share for the first quarter was going to be negative 6.7. As of last Friday, with 53% of companies having reported, the tracking EPS for the first quarter is only negative 3.7%. And that's probably going to get even better in the final 2 to 3 weeks of this remaining earnings season. So with that, and most of you know, I follow all the strategists out there that are seemingly consequential to markets. December 5, 2022. And Savita Subramanian up on CNBC telling you why it was going to be a rough January and how she believed, earnings estimates needed to come down, 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 down. $200 a share is what they thought S&P 500 earnings would achieve in 2023. Folks, I've got here's the actual video from back then, 4 months ago there. But look what I said. You're going to want to save this one, folks, because, well, she's a perma bear. This has nothing to do with actual analysis that she does. She's negative every single year. She's literally hit her price target for the S&P 500 twice in the 9 years that she's been in the subordinate strategist, if not chief strategist for Bank of America. Twice. Both times we had bear markets. It's the only time she's right, because she's always looking down. So I say you're going to want to save this one, folks. Has happened to Savita every single time in the past, and no reason to see why it won't happen again. Meaning that she's going to be wrong. She's going to extend her bearishness too far because it's the only thing she knows. Earlier in April, however, heard on floor 16, 1 Bryant Park, which is the Bank of America building, headquarters, if you will. One-liner from our fundamental equity analyst ahead of earnings indicate that Q1 demand held up. Well, no crap, right? Look at GDP. And then here's the results. Now, the latest note out of Bank of America, 3% beat, upside risk. There is upside risk to our $200 forecast for 2023, meaning that more than likely, assuming no recession, assuming no exogenous shocks to the economic system, earnings are probably going to be higher than their forecast of 200. This is what you call laying the foundation for a revision to their outlook. With that being said, I hope you enjoyed our brief here this Sunday evening, and I hope everybody has a great trading week ahead. Take care. Join us here at phenomgroup.com. Hit the like button, share this with your friends, hit subscribe. We'll see you next time.